So you can see the dollar index. Last time we talked, we were down in here, and I said I wanted to see it, kind of like give me a little bit more inspiration behind it. I told you I was expecting dollar index to go higher. I was bullish on dollar, framed off of this inversion fair value gap, then the bullish fair value gap in here, and then using the consequent encroachment and quadrants of the wick in here. And then we have this inversion fair value gap with the volume imbalance. The market started to rally up, took out the buy side in here, and worked inside of this sell side imbalance, buy side inefficiency, which is graded. You can see that the upper quadrant was pierced by the bodies. And then on Friday, we had a little bit of retracement back down into a volume imbalance here. We have a suspension block, which is a candlestick that has a volume imbalance to the high end of it and a volume imbalance to the low end of it. The candlestick need not be an inefficiency. In other words, it need not have any one single pass with the candlestick. So it could have a candlestick to the left of it that was a full-bodied candle, or a wick that completely overlaps the entire range between the upper and lower volume imbalance. Okay, so that's the distinguishing characteristic. This is why this PD array is a little bit different than you probably thought it was the first time I mentioned it. Anyway, we have a suspension block here. The market trades from this open here down into midpoint of this range. It's shaded in blue. And we traded right back down into that on Friday. The market trades above the upper quadrant. That's this 99.368 level. We pierce it, we break lower and shift in market structure there, and a retracement up. So you can see the 79%, 62% retracement respectively. That's optimal trade entry. Very minimum, it's got to go above the low to high. It's got to go to 50% or higher for it to be in a premium market. And that's the ICT model 2022. So the market trades up into optimal trade entries. We have an inversion fair value gap, which is this buy side imbalance, sell side inefficiency. We break below it, leave it here, and then come back in. As you see, the bodies are finding resistance. Okay, so there's premium sensitivity here at the consequent encroachment of that inversion fair value gap, and the market gives up the ghost and breaks aggressively lower, trading through the midpoint or consequent encroachment of this inefficiency here. And it's this range from the low of this closing candle price, volume imbalance included, up to this candlestick's low. Now I have it shaded in pink because it acts as a premium array to draw up into. I'm not classifying it technically as an inversion fair value gap. That's why it's not orange like this here. Okay, so don't be confused by that. The orientation is when price was down here, I was expecting price to drop into it. But we use that area up here as a premium array to retrace back down into a discount array, which is this suspension block. So you can see that volume imbalance right here, these two black line segments, that's these two segments right here. The market falls out of bed. We have a breakaway gap. Here is for your notes, the breakaway gaps, the inefficiency that shows up on your chart that does not get filled back in. If it's between a quadrant level like this and another quadrant, expect that when we are looking for lower prices, when it breaks lower, if it leaves a quadrant like that and breaks a little bit lower, this is many times going to act as a breakaway gap because it's in no man's land between a quadrant and another quadrant inside the narrative and bias that the market's moving one direction. And that's how you see a properly classified ICT breakaway gap. The same thing can be said for measuring gaps. So a halfway point, when there's a gap that is during a move, if it's between a quadrant of either an inefficiency or an actual gap by a wick. So if you're grading your price PD arrays, as I teach, whether it be a candlestick wick or a inefficiency in price action where it's a body that's being measured, not the wick. Either way, if you're grading those price levels and you see a gap that appears between two quadrants, then its chances are it's going to be a breakaway gap or a measuring gap. Market breaks lower, trades down into that suspension block high here, which is the high of this volume imbalance. It's hit there perfectly, rallies back up, finds the low here of that old inefficiency here, which is a buy side imbalance, sell side inefficiency with the volume imbalance at the discount level, low end of it. So that price is at 98.898 and it hits it perfectly to the tick there, working off of a volume imbalance also that's not noted. Rallies up. This portion of this SIBI, we can grade that because it's anchored right on top of a lower quadrant level, meaning the lower quadrant at 99.054, that's this level here, which is 1/4 from the low of this buy side imbalance, sell side inefficiency. Because the gap is laying over top of, and key point here, below inside the narrative that the market should deliver lower, and it's below this inefficiency, which we should expect that to be a breakaway gap. When another series of SIBIs form, this one we look at it as staying open, or we want to see it remain unfilled. Can it come up and trade into it a little bit? Sure. But we expect some measure from its halfway point to the high of it. That portion should likely stay open. Here, this SIBI from this candlestick's low and this candlestick's high, that's denoted with these red trend line segments, we can grade that, and the bodies are stopping right at the midpoint, which is exactly what you want to see when the market's bearish, showing you premium sensitivity, reacting to half of this inefficiencies range. Even though there's a little wick there, the wick didn't even touch the upper quadrant. The bodies are staying at the halfway point, indicating what? As I taught, this is heaviness. Algorithmically, it's indicating, tipping its hand to you, that the market will want to seek a deeper discount. What would that be? Below that low. And it trades down to the lower level of this volume imbalance. And we have a volume imbalance there, trades up into before it gives up the ghost. Inversion fair value gap right here as well, trading at its halfway point. Breaks, comes right back up into a volume imbalance. Trades lower quadrant, perfect delivery, and trades down to that volume imbalance on the daily chart right there. So all in all, just a really good technical Friday. Moving on to euro dollar, just pretty much the opposite. We can see their sell side liquidity here. They tapped into that during New York open and kill zone, 7 o'clock to 10 o'clock in the morning Eastern time, always New York local time. We have the ICT model 2022, low, high, 62 to 79% retracement level. You can find that on your own charts here, but we have a inversion fair value gap. This SIBI changes its characteristic when we trade above it. We come back down in. The wicks are digging down, but we don't get to the low here. The bodies are staying close to what? Consequent encroachment. It rallies up, uses it as the discount sensitivity, and then rallies away. All these wicks converging around this level here at 1.15740. That's this old candlestick's low, which is being graded. Okay, why am I picking this one? Because it's lower than this one and it's lower than that one. So it's the lowest reaching when price was dropping down. And below that, we have this buy side imbalance, sell side inefficiency. We trade into that right here, okay, which is not being shown in the chart because it's during Thursday's trading. Friday's trading had a higher low, that low being at the upper quadrant of this wick. Why am I using this wick? Because it's lower than this wick and it's lower than that wick. And this wick is lower than that one. It's very specific rules. In all of this price action in here, where's the lowest reaching wick? This one. It's pretty obvious, isn't it? Look at all of them. This one here. This one's being graded because it's lower than this one and it's lower than this one. And it dug into this inefficiency that's shaded in blue. So if it's going to trade down lower, we have to consider this wick before we even consider this low being taken out and trading to consequent encroachment of this buy side imbalance, sell side efficiency. So Friday, we can see we're using this discount wick and the levels there. You can see them being used over here. So the low of that wick there, right on here, it launches from there, trades above the quadrant, lower quadrant, and then tears off. So this portion down here, that would be what? That would be a breakaway gap. This would be a standard buy side imbalance, sell side efficiency, or BISI. You can grade this one and you can get down here to the lower quadrant. The body's respecting that as well. We trade up into the upper quadrant at 1.16220 of this discount wick. Why am I looking at that? Because it was a discount array when we were trading lower, and now when we were below it, it's going to act as what? It's going to change its characteristic to a premium array. So if you're going to grade it like a gap, you have to have these levels in mind, and it trades up into that as well. You want to take this high down to that low and duplicate that range and project it up, and you'll get pretty much this area in here. Okay, so the buy side imbalance, sell side efficiency here, almost complete closure. We have a inversion fair value gap that's not noted, and it's traded down to its low here, rallies up. Then the consequent encroachment, it accumulates once more, and then starts to send a little bit higher. We have a minor buy side liquidity there. All right, moving on to pound dollar. We talked about this gap here, and I talked about the quadrants on these wicks. So you can see what happens after that, right? Down she went, tearing into this candlestick's premium wick, upper quadrant, consequent encroachment in red. So this wick is the lower of this one inside of this portion of price action. So this low, this area in here, that's the lowest one. Lowest reaching wick is this one here. So you're going to grade that one. Okay, so we're going to ignore this range here, because the algorithm is going to see past this and go right back to this inefficiency. Why? Because this level of wicking is treated like a gap, and a gap is reused even after the gap has been filled, and it would be considered filled with this drop down. It went below that low. But the algorithm is not going to just toss the baby out with the bathwater. It's going to refer back to that reference point. So we cut through, looking through time here. We have a high, low, higher high. Everybody knows that that is my bearish breaker. But what happens when the market is bullish and it trades above it? It's going to treat it as an inversion breaker. Every PD array has an inversion aspect. So we use the mean threshold of that last down candle, which is the bearish breaker. But now it's going to act as what? A bullish PD array. So you can see the body stopping dead on the midpoint, mean threshold there. And then we had the opening right at that same price. It rallies up. The next candlestick, we drop down to it once more. See, there's discount sensitivity there, rallies. And then the candlestick opens right at the high of that candlestick's high. And then digs into it a little bit and then rallies aggressively, creating what? A breakaway gap, clearing this high. Let me tell you something. If these form after you have a breakout of price action during a consolidation, I never want to see these traded back into. If it has the willingness to come back down into that and fill that in, that's not strength to me. Order flow is when there's an inefficiency after discovery, which is leaving this range here, taking this high out. When we do this, we want to see price keep that open. As long as this remains open, we have a bullish order flow. We do not anticipate market coming back down and closing and then going higher. Because if it goes down and closes that in, I am not all that bullish then. Can it do it? Yes, it can. But it's more problematic if it does for continued price action higher. You want to see the indication that, yes, there was an explosive price action move higher. It created an inefficiency, but the market is so overzealous to move higher, it need not even concern itself with coming back down in here, offering a discount to people. But this is a breakaway gap because it's taking out this high and then we are entering discovery. That means it's going to discover how much it can move and still allow traders to keep buying it. It just keeps offering higher, 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 higher. And all of this price run in here is used to then weigh on the sentiment of market participants because at this point down here, they may have seen this as a bear flag, got real heavy and thinking, wow, it's really going to go lower. Then it starts to consolidate. And then we start to move higher and they don't know what to do with it. And then when these highs get taken out here, then all the Johnny-come-latelys pile in and say, well, we always knew it was going to go higher and we're going to buy out on a breakout. And they're thinking, they're buying strength, but they're chasing. Where's their stop loss going to be in all that price run? It's too big. So the market trades up into the consequent encroachment level here of this wick at 1.33637. And you can see that level here. You can do a measured move type thing here. The same range from this high down to that low, duplicate that and send it up here. And you'll pretty much get the bulk of where the bodies are converging right there. Index futures. And I'm showing October 2nd. I was teaching you to take the regular trading hours opening range gaps and those quadrants that form and project them in the future. So it's a matter of experience. And what you're going to discover is the ones that are so obvious and they converge and lay over top of or in very, very close proximity to another supporting PD array, whether it be an inefficiency or a gap like the wicks. If it's laying on top of a quadrant level like that, and it's also time anchored, in other words, if it's time for it to move, it's at a session open. It's during the first 30 minutes of the opening range, or it is inside of a macro time. Man, you have a loaded deal. You should never, ever, ever entertain the idea of trying to pick a top in the marketplace. I was surprised that it happened in one day. Like it was a lot of movement in one day. I expected this to kind of like bleed over into next week, and it still might do that, but it just really over delivered. And I want you to go back to, again, the posts I was making about Thursday, October 2nd, and I told you to take those levels, the apt student would carry those over into the right side of their chart and keep extending them to the right. If you go to your daily chart, and we had our old all-time high here, they formed as relative equal highs, this high being slightly lower than that one. So that classifies this as a high probability candidate for a run on liquidity. It's less likely when the right side is higher than the left because we've already done the damage there by running the wick of this candlestick. So we created this short-term all-time high and we traded lower. And then we had this candlestick here. We pierced it, but look, we only pierced it with a wick. That's not meaningful to me. It's insignificant. It's unfinished business, still above this candlestick high. So on this day here, we have October 2nd. The market creates this open. We trade down and we rally up here and then come off the high right there. This day, October 2nd's regular trading hours, opening range gap, that's what this 5-minute chart has been showcasing. So these levels here are what I was referring to. They need to be carried into the future. Why did I say that? Why not any other being specifically mentioned? I said in the October 1st that you should look back over the last 3 days. Always go back over the last 3 days and include them. So technically, you're going to have whatever the trading day that you're trading, that opening range gap, if there is one, in its quadrants. And then, so what do you have in your charts technically? 4 opening range gaps and their respective quadrants. So when I say you have to have 3 on there, it's not just 3 sets of opening range quadrants. It's today's trading day and whatever opening range gap quadrants there may be associated with it. And then yesterday, the day before it, and the day before it. And you have to go back into the previous week. If you're looking at, like, say, for instance, on Monday, you'll go back to Friday, Thursday, and Wednesday of the previous week. If there's a holiday, you're going to skip over that and just go to the market day. This day, we have a body left above the previous all-time highs. This right here is much more meaningful. So this day's opening range gap is going to be highly, highly significant. That's why I told you to carry it and go forward. And you'll look at all these days here and you'll see those levels, which are these levels here, they're being used by the algorithm. This is a video where you want to probably pause this video right here, go and get your levels on the opening range gap for October 2nd, okay? And then study the 3rd, the 4th, 5th, so on until we made this high up here. Notice how it was used all in this area here. And you're going to see that there's a lot of wonderful confirmations, setups, stop loss management ideas that could be utilized and implemented. Lots of scalps, lots of wonderful scalps. And I teased even while I was away that look at this. Even today, it still used the upper quadrant because I'm poking and I'm prodding you to consider this information because it's not random. It's not made up. The candlestick that left a body above all-time highs. This logic also works when it's not trading all-time highs. But I've learned 20 years into my career that this is something that tends to repeat at all-time highs. Now, I've only had a few instances in certain markets to see all-time highs form. I've only been around for 53 years. The idea of a body being left above that old all-time high, this could be still used if it's just a old market high. If you're looking for the market to trade above an old all-time high, it's this logic and any old high where we look at this candlestick, it leaves a body above it. Whereas by contrast, this one only wicks above it by a little bit. So I want you to understand there's a significant departure from just simply going above it price-wise and then leaving the body above it. Okay, this is much more salient and more information indicating that the algorithm will now utilize that candlestick's opening range gap levels, and that's these levels here. Okay, I also showed this lower quadrant here. It's perfect precision here. Why am I picking this one? Because it's the highest one in this swing high. Lower quadrant. Trades it, hits it perfectly, and sells off on that day of October 2nd, 2025. But now watch what happens. I want you to pay attention to the daily chart. Over here, we have a buy side imbalance, sell side inefficiency. Volume imbalance toward the discount end of that BISI, and its candlestick's low is the high. Graded, here's the upper quadrant, consequent encroachment, lower quadrant, and then the low. This portion here of that blue box is being shown right down here. The buy side liquidity pool here is this blue line right there. Thursday, regular trading hours, opening range gap, lower quadrant. This is the opening range gap low on that Thursday. Consequent encroachment of Tuesday, October 2nd, opening range gap. Here's the upper quadrant, and here's the high of Thursday's opening range gap high. Over here, this candlestick here on the 2nd of October has a little arrow above it. That closing price. Everything I'm saying here, when you're looking at markets trading at lows that you anticipate trading below an old low and looking for accumulation to go higher, you're going to reverse everything I'm saying here. But for now, I'm focusing on how we can not predict, but I'm showcasing how you can see real accumulation and real distribution in the marketplace. Bodies left above old highs right there. That closing price, as soon as that day closes and a new one opens here, that price right there and anything above it, smart money will start staging shorts. If we're making an all-time high, or if we're making a long-term high or a significant intermediate-term high, and we expect to see a decline that's tradable, you want to reference in the market when it's bullish. If you're anticipating a turnaround, you want to indicate every closing price. That's what I'm indicating here. So October 2nd, 2025, this price is what's being indicated, which now appears here on this chart. So everything at that price and above, smart money is looking for PD arrays to get short on. They're running out old highs, selling into that. They're selling into that. They're building large portions because they have to act like a commercial trader does in commodities. They enter early. When big positions are sought after, they start putting in positions early. Where do they and how do they do that? Everything above this closing price, anything above that price is going to be chased by what? Retail. But when they're buying it, smart money is selling to them as they buy. So at this point here and above to this candlestick here, all this is where smart money is accumulating swing trading perspective, duration of time, not a day trade. They're staging in that range shorts. And then we get this day, we have a higher close price than the previous one. So now above that price and higher up to here, smart money is looking for PD arrays, old highs to sell into when it goes above it, or trading back up into premium arrays. They're selling short inside that area. And then finally, we have this closing price here. So we have 1, 2, 3 stages of smart money shorting. They're staging their short positions. As the market's going higher, they're feeding that buy liquidity to the people that want to chase price higher. They keep, it's going to keep going higher. You can see what they're doing with the candlestick wicks. Yeah, we were here at this highest point here, but we closed down here. Yeah, we were high up here, but we closed right here. We were high up here, but we closed way down here. We are high here, but we closed right there. That's distribution of longs and accumulation of shorts by smart money. Do not think like this only with all-time highs. Every time the market creates intermediate term or long-term highs, it does these same things. But at all-time highs, you want to see an all-time high form and then a deep retracement, and then it gets taken out, and then start looking for these types of scenarios. So here we have this portion here at this candlestick's closing price, and anything above it, they're going to be utilizing premium arrays and selling short of old highs because they have deep pockets. They don't have to have the same concerns that you have to have. You want to trade big positions, very, very small stop losses. They don't need to worry about that type of stuff because they're not over leveraging. They're scaling in, they're scaling in, they're scaling in. Now, time element. It's Friday. We're at all-time highs on Thursday. We open up on Friday. We trade up into that Thursday high and we grade that. Upper quadrants pierced, but we can't get to the high of it, and we trade lower. As it starts to trade lower, everybody's talking about the comment that Trump made about the 100% tariff on China. And that news is the justification. It's what the market's doing before he speaks. And then all the excuse, all the blame, when I'm going to show you it's not that at all. We jump ahead and we're looking at Tuesday price action. We open up higher. We have a small gap in here. So it's regular trading hours being shown. And the idea is that we see it trade lower above this closing price. So we use that price here. So there's discount sensitivity. It rallies above previous high here. So it's above that buy side. So they're selling into that. They're selling into that. We come back down into that October 6th closing price. Then we have a gap opening higher. We rally above previous high. Then we sell off. Small little civvy in here, sells off and trades down into what? Thursday's regular trading hours, opening range gap, low. That's this dark line right here. Here's the lower quadrant. Here's consequent encroachment. Here's the upper quadrant. Here's the high of it, which is the opening price on Thursday, October 2nd. So don't be confused with these annotations. I'm referring to only October 2nd. Why? Because it was the candlestick that had the body that was left above the previous all-time high when it formed and then retraced away from it. Really, really important. You're going to need to watch and listen to this video a few times, but then go back and look at your old price moves. It doesn't need to be all-time highs, and you'll see exactly what I'm saying. Look at the levels. It's using the upper quadrant here, hits it, sells off. Lower than that, it's the consequent encroachment level. Look at the body respecting it there, and trades down to lower quadrant, and down to the low of it. This is literally 5 days after October 2nd. It's a very simplistic approach to understanding why price is going to do what it's going to do and when it should do it. Look at the times when price is hitting these levels. There's the epiphany. Moving forward, here we have Wednesday, October 8th. Now we're above that October 6th closing price. That's over here. All these wicks, we're seeing that form in here. So everything in this price run up here, again, every time price runs above this high there, smart money's adding to their short position. This high here, as it trades above it, they're adding to their short position. Here, this high, as it trades above it, they're shorting more. Up here, they're shorting. What is this? It's an inversion fair value gap. Price breaks that low, trades down, there's your short inside of another fair value gap there. Beautiful delivery there. Trades back down. What's it trade down to? That's the high of that opening range gap on October 2nd. Hits it, and what does it do? Stop. It flirts just below it a little bit with the wicks. and then rallies away. The market on the 9th, here's Thursday, creating the high. We have the market trading in an area where the October closing price here on the 8th. The 9th, we open, we rally up in this little portion of price action in here. All this, that's being graded up here. You can see those levels here at 25,393 even. That's this candlestick's high. So it's over here, previous. Looking at it, the bodies are stopping right at consequent encroachment. And we're above buy side on this swing high here. Deep retracement. It trades down into what I tell you, Thursday's regular trading hours, opening price. So that was the high of the opening range gap on Thursday, October 2nd. The only reason why we're constantly keeping these levels on our chart is because on the daily chart, it was October 2nd that left the higher bodied closing price above the previous swing high that made all-time highs. Carry that over into when you're not trading at all-time highs, just using it for market structure purposes. When you're trading above an old high and you're expecting a long-term or intermediate-term high to form, you're using the same logic. It just works more frequently because it's rare that your markets that you're trading are at all-time highs. It takes a lot of time to get to these all-time highs in markets. So here we have it. Point is, the market's already indicating it's tipping its hand. The bodies are not able to close above consequent encroachment of the 9th price action. So when we start trading on the 10th here, it's faltering, it's failing. It can't muster up the strength to get into a run to make a higher all-time high. And we've had 3 stages of smart money shorting. This price that is too far to the left is the old buy side. It trades above it here. That's your first indication that we laid down a body and a closing price at an all-time high, above an old all-time high that was a swing high. So here's the stage 1, here's stage 2, and stage 3. Anything above those closing prices, smart money is putting in shorts. The market trades right back above, right in here, above buy side here, and taps October 8th, 2025's closing price after just a hair pierce above it. And then that happens. Inversion fair value gap. Small little volume imbalance in here. You'll check your price to see it. It's very small, but it's there. Market trades up, falls out of bed. 3 stages of smart money selling above an all-time high, indicated by failure by the bodies not making any headway above consequent encroachment. If it would have been above it, then we might have to make a higher high, but it's not. And I taught you this. This is how you read order flow. When you start seeing the science that I'm showing you here and the closing prices are giving telltale signs to smart money that it's about to turn. Why? Because we couldn't post a body above consequent encroachment of this wick. And it's time. Friday. Inversion fair value gap. Failure to go higher. We're consolidating. And then we go into the macro. 10:50, 11:10 a.m. Overlapping with London close. Look at your euro. Look at your dollar index. And look at your pound dollar again. And then the market starts to drop. People are in shock. So here's where we're at. Inversion fair value gap. Macro 10:50, 11:10. Trading at the closing prices, a third stage of smart money shorting at all-time high. And when we're tapping that buy side, and it careens lower and back into that those Thursday levels. We trade down below consequent encroachment of Thursday, October 2nd, 2025's opening range gap. It wicks through it twice. Where's the bodies? Below it. Why am I using that Thursday, October 2nd opening range gap? Because it's the one that had the daily candlestick close that laid down a new all-time high above a previous all-time high that was formed, that was retraced on. It should be viewed as what? Continuation. But I'm looking for indications that smart money will fade into that and start selling it. Distribution here inside this SIBI. Volume imbalance. Volume imbalance. This is what? Suspension block. Halfway point, consequent encroachment. Can't even reach that. And the bodies are staying below what? Thursday's regular trading hours, opening range gap, consequent encroachment, midpoint level. It can't even muster the strength to come back and kiss it with its bodies. It's heavy. So where could it reach for? Go back to your daily chart. We have a swing low. We have a discount wick that you can grade, and then we have the change in the state of delivery down here. See this down close candle all the way past this one. So if we're going to pierce this, this is the last time before this candlestick formed. This was the last time there's a change in state of delivery. So this candlestick's open to its high. That is your premium wick. When price is above it, it's going to act as what? A discount wick. So here's the lower quadrant, consequent encroachment, and the upper quadrant. Lower quadrant comes in at 24,166.50. And during regular trading hours, trailing stop losses getting stopped out. It is what it is. But that is a really, really nice run. Carrying it over to electronic trading hours, where you can see that there's trading beyond that 4:14 p.m. Eastern time. This big drop off went right down into that there beautifully, with just below the low. But look at that delivery. Am I going to sit here and tell you that it was expected on my part that it was going to deliver such a long drop down on Thursday? No. You have to be careful. An overnight gap risk should be your number one priority, not assuming it. Don't hold overnight. What prevents them from opening up 1,500 handles different from where you last saw it? Nothing. That's the thing you don't understand. Like, you think that there's got to be a method that prevents things like that. It isn't like that. Remember, you think smart money's not short right now? Look where they've moved it. They are not letting other people in on that move. They've already shifted this thing a lot. Now, what do you think the public wants to do when they can get in the market and trade? They're going to do what? If they're long, they're going to be scared and they're going to try to get out. And people that don't know how to trade see it as, wow, it's probably going to start dropping now. You should not be trying to do anything right now. It's already moved a lot. So just sit still, wait for the dust to settle a little bit. And if it keeps going lower and you miss it, that's better than trying to chase it.